Hello everyone, my name is Nathan. I'm a business finance student and today I'm going to be talking about mortgages in 5 minutes or less. First, what is a mortgage? According to Webster's dictionary, a mortgage is the charging of real or personal property by a debtor to a creditor as security for a debt, especially one incurred by the purchase of the property, on the condition that it shall be returned on the payment of the debt within a certain period. Sheesh. However, the word mortgage is a compound word that comes from Old French, mort, meaning dead, and gage, which means a pledge. Now I know what you're thinking, but no, a mortgage isn't a pledge that you will one day die. Instead, it was created with the idea that you could only get out of the debt by A, paying it off, or B, dying. That was serious stuff. Essentially, a mortgage is an agreement between two people or groups of people where the borrower can take possession of a property or real estate before they have even paid it off. But why would we do this to ourselves? For one simple reason. Usually a mortgage is taken out because the average buyer doesn't have enough cash. According to the United States Census, the average price of a new home in March of 2016 was a whopping $356,200. Now, mortgages can be long and complicated, but bear with me. It essentially breaks down like this. Say you want to buy a house, but you definitely don't have $356,000 lying around. What do? Take out a mortgage with a bank. Now, the bank will purchase the home for you and then set up a mortgage, where it will require a significantly smaller monthly payment. Pretty cool, right? However, the bank is actually getting a good deal out of this because of one scary word called interest. Let's break down how the payments work. Every month, the bank will have a mortgage payment that consists of a few different things. First is your scheduled principal. Now, this is the amount that goes towards the actual appraised value of your property. The crazy thing about this is your principal is often a pretty small percentage of the next item, interest. This will be measured off a set rate determined by the borrower, their credit score, and the bank. The next item is an option for the borrower to pay more towards principal each month, called an extra principal payment. This is nice because it allows the borrower to pay more money towards the actual value of their property and not throw it down the drain to the bank. The last item is called a PMI payment. Fortunately, the death penalty is not in place for not fulfilling your end of the mortgage anymore. However, the bank will often require this payment as a kind of insurance just in case you go AWOL. Finally, this leads up to your total monthly payment. Now, if you want to own a home one day, is this your only option? No, there are different agreements and arrangements that can be organized with different lenders. For example, graduated payments. This is for those poor college students, like me, who'd like to own property sooner rather than later, but don't have the money. All this does is weight the payments so that the borrower pays very little each month at first, but then has higher rates toward the end of the agreement. A second option is called a balloon payment. This one is very nice. Some banks will simply accept a balloon instead of money. Haha, just kidding. This is an agreement where the borrower can pay monthly payments for a shorter term, and then once they have enough to pay off the principal, they can pay a lump sum that closes the mortgage. The last option I'll talk about is a wraparound mortgage. This is simply a plan for someone who is planning on selling a property to have a more frequent payments, perhaps twice a month instead of just once. That way, they don't have to pay a full month if it's going to be sold in the middle of the month, for example. Well, I hope you enjoyed this video and hopefully you enjoyed learning a little bit more about mortgages. Take care and good luck on buying a home.